So it's natural gas time again, and after the weekend meeting in Japan with all the G7 people going, we've got to cut supply on natural gas and we've got to stop using it, gas prices surged, which is not surprising, even though this is going to have no impact in the short term overall in terms of new rigs and new pipelines and new exploration, all that sort of thing. This is a long-term idea and there's no decision on the timing of any of this stuff, and it's all just fluff and nonsense really. But these markets react to sentiment and ideas and concepts and emotion, and as a result of all of that talk, we saw the price of natural gas surge. It's quite interesting that we gapped up above this 20-day moving average and continued to rally yesterday above this support. I talked in the previous video about leapfrogging these moving averages which are in confluence around the 212 level, and that's exactly what happened. The moment the market opened on Sunday night, my time, we were above this collection of moving averages, which would have provided a fairly stiff resistance. But if you can't go through it, just leapfrog it. And that's what the market did. And a couple of hours later, we moved up above this resistance level here. So let's go back to the daily chart and see where we are at the moment. As I've said to you, it's not worth chasing this move. We don't want to be FOMOing into this and fear of missing out. There's still a lot of resistance up above us, and you can see immediately that we've got the 50-day moving average just hovering overhead in this green zone here at around about the $2.35 to $2.40 level. And then, of course, we've got the various other resistance levels above us before we get to our ultimate target of what I now call $3.50. But it's that pink range there where you'll also find the 100-day moving average. So where does that leave us in trading? Well, as you know, I'm long from $2. I'm considering hedging half of that at around about $2.35. I haven't decided yet because we haven't got there yet. The alternative to hedging is just to take half of that position off and wait for the market to move back down towards this support. But I think there's every chance that we'll at least get a dip back down to around about $2.22. And it's also not to say that this rally is the start of a new move higher. We could see this market fall all the way back into this range, back down towards the $2 level. And then potentially we've still got $1.80 and $1.50 below us as sort of price magnets in the extreme case that the market wants to move lower. I don't really know. We've had some what you might call slightly bullish talk over the weekend from the G7 meeting, and the same supply and demand equations are in place, and the weather considerations remain in place, potentially a warmer summer, therefore more gas usage, but maybe not. Who knows, the weather changes all the time. So don't rule out a drop back down to $2.22, maybe $2, and I think more unlikely than before, a dip down to $1.80 or $1.50. For now, I'm holding my long position, and depending on price action around about this level here at 235, where the 50-day moving average is, and this first resistance zone is, I'll decide what to do, potentially taking off half or hedging half. If I do hedge half and the market moves back down to $2.20 or $2.22, potentially even this 20-day moving average, which is now at $2.15, then I'll take off the short part of that hedge and leave the long side on, which will still be in profit, and I'll have gained a little bit from the short hedge, selling up around 235 and closing at around 215 or 220. So that's the overall plan. I haven't quite decided just yet. If you're not long on this market at the moment and you want to get long, don't chase this move. Wait for a move back down to 220 or 222, or perhaps down to 215 or 210, where this 20-day moving average is, and this gap is, which might quite like to be filled at this stage, I don't know. So we could get a dip down into 215, perhaps 212, 210, somewhere around there to fill the gap, touch this 20-day moving average, perhaps just pierce through it, and then bounce back up again to resume the rally. That would be the best place to go long. And at the risk of missing out, and of course that's where FOMO comes from, at the risk of missing out, it's probably best to wait for a dip before getting long on this market. So that's natural gas. As I said in the video title and description, we'll have a quick look at sugar as well for those of you who are trading other commodities apart from gas. Believe it or not, there are people that do trade other things apart from natural gas. And you wouldn't think so by looking at the YouTube plethora of videos on natural gas, but sugar's an interesting one. And the reason I like this is because we're approaching long-term resistance at around about 25, 24.8, but I've just put this line at 25. And we've also got a very overbought market having broken out through this range top a week or two earlier. What's interesting about this is this sort of collection or group or cluster of reversal candles on this daily chart for sugar. You can see we've got this sort of hanging man shaven head candle, followed by this dark cloud cover candle the next day, followed by a shooting star with a shaven bottom the next day, hesitation candle. Day before yesterday, we got another tiny little hanging man candle with a tiny little wick on top, and then a small gap down into the price today. So that cluster of candles contains 3 or 4 reversal type candles after a prolonged uptrend and in overbought conditions in a market where the price really should come down. I know commodities are expensive because the dollar has been weak, but there's also an argument to be made that the dollar may have made a double bottom and the dollar index is likely to rally in the coming days, which will bring the price of commodities down in general. And sugar is one of the best candidates for that. So I like this cluster of reversal candles. You can also see if we switch to a shorter term chart, this is an hour chart, and I've drawn it in very roughly, but this is a diamond pattern right at the top of this trend. And apart from all those daily reversal candles, this technical pattern, no matter how crudely drawn I've done it, is actually a reversal pattern in itself. So that's encouraging for this trade as well. So that's sugar futures, and I'm looking to short that today. And then we've talked about natural gas. We're long on natural gas with a potential to hedge this trade at around about $2.35. And that's something that I'll decide later, depending on the price action, if and when we get to around about this level at 235, where the bottom of this resistance zone is and this 50-day moving average is coming in. Well, good luck on those trades. And if you're interested in what we're doing with things like oil and gold and currencies, have a look at some of the other videos on this channel. And why not subscribe to this channel while you're at it. Take care.